Hello and welcome to our webinar at Invesco today. My name is Eva Miklasova and I am Head of ETF Business Austria and C at Invesco. And today for this webinar we have invited our guest from London, Chris Mella, who is EMEA ETF Head of Equity Product Management at Invesco. We will talk today with Chris about ETF flows and trends, about US equity market, and the most popular indices and ETFs on the market. But before we start, just a few facts on Invesco to give you an idea who we are and why we are an important player in the market. Invesco is leading independent global investment firm with around 1.7 trillion US dollar of assets under management. We have more than 8,500 employees and with very broad coverage of the clients around the globe. We manage active mutual funds, real estate, private equity, institutional mandates, solutions, and ETFs. Regarding the ETF business, Invesco is the fourth largest ETF player globally. So now let's talk about ETF market. Global ETF market has been growing further in 2024 and reached over 13 trillion US dollar with record new money in EMEA ETFs with over 130 billion US dollar. So, my first question to you, Chris, would be about ETF flows in Europe. Please, could you share your observations about the ETFs of EMEA investors in equity space? Which regions has been demanded by investors since the beginning of the year the most?
Of course, Eva, and thank you for allowing us to join this call. So the first thing I'd say is, we've seen extremely strong demand for ETFs in EMEA. On your screen now, you can see monthly net new assets, NNA. So this is creations of new assets in funds in the ETF space in Europe. On the left-hand side, you've got the average monthly figures for recent years, typically running at sort of around sort of 10 to 20 billion dollars in aggregate. And then as we move into 2024, you can see the monthly figures. So the first thing I'd say is that as the headline says, Q3 was a record quarter for net new assets in EMEA ETFs. With $68 billion of inflows into the ETF product space. That took assets in EMEA ETFs past the $2 trillion mark for the first time. And if you think about the size of flows that we're seeing, $68 billion in the quarter is about, is more than 3% organic growth in ETFs in just one quarter. That's built on a relatively strong second quarter. And really gives you an idea of the momentum we're seeing in the ETF market. You can see that the different bar colors are giving you a breakdown of ETF flows by asset type. So equity flows have typically dominated in the European ETF market and ETF markets more broadly. And again, in Q3, we saw the strongest flows were into the ETFs, into the equity ETF space. However, it is worth saying those purple bars for commodities for fixed income were also pretty strong. And as a percentage of fund assets, fixed income is actually growing quicker than equities overall. But the predominance of equities in the space means that the total NNA number is bigger there. In terms of the breakdown within equity markets, the chart on the left is showing you cumulative NNA over the year to the end of September, and you can see that there are quite clearly two parts of the market that dominate flows. That's global equities, the dark blue line, and US equity exposures, which is the light blue line. And that's very much been the story for a number of years now. Perhaps unsurprising, the US equity market is the biggest market in the world in terms of market cap and weight in indices. And of course, global equity products make a good one-stop shop for getting broad equity exposure in an easy fashion. So we see a lot of flows in those areas. On the right-hand chart, I've expanded out the other regions and asset types, and you can see again that the grey line there, the second or third strongest flow, I should say, has been into Europe. Perhaps unsurprising, you would think for European domiciled ETFs. However, I'd say that this is a bit of a change in behaviour. European equities have been out of favour for some time, but signs of it coming back. Equally, emerging markets has ticked up in the last quarter or so, particularly helped by the strength in appetite for Chinese equity market, and direct China exposures also ticked up at the end of the quarter as well. But like I say, flows have been dominated primarily by US and global equity products.
Okay, I see. So as you mentioned, we see the biggest inflows in the US and global ETF products. So now what about the performance? Which equity region has performed the best?
Yeah, so I guess the flows perhaps also reflect the performance picture. You don't always see positive flows for the best performing markets, but very often there is a momentum effect perhaps. And certainly if we look at performance year to date, you can see that the best performing markets here, top of the chart, the light blue line is the Nasdaq 100 index. And of the broad regions as well, the second strongest is also US, which is the dark blue line, which is the S&P 500, both of which have outperformed significantly against the broader global market, which is represented here by the pale pink line of MSCI World. And you can see that both Europe and emerging markets have lagged somewhat compared to the sort of heady performance of the US equity market. I've also included here the performance of the CoinShares Blockchain Global Equity Index, sort of drilling into a sort of much more specific thematic type of exposure. And you can see that, again, this has been an area of the market that's seen a lot of appetite, a lot of interest, and meaningful outperformance of the broader global equity market since the start of last year.
So next to kind of blockchain global equity index, US equities, both Nasdaq 100 and S&P 500 has been the most demanded so far, and as well has the best performance so far. So both indices are US equity indices. So what is our outlook for US equities?
Yeah, so the US equity market has performed extremely well, and there's a number of factors behind that. Not least has been the strong performance of mega cap tech stocks, in particular those related to the AI growth story represented by the so-called Magnificent Seven, the seven mega cap companies that have performed particularly strongly in recent years. So you may be forgiven for thinking that the outlook for the US market is entirely dependent upon those stocks. I think the reality is, though, that there is a much broader story to the US outperformance, which is also driven by sort of broadly stronger economic activity than most other global markets, a more reactive, perhaps, monetary policy from the central bank, the Federal Reserve, and strong fiscal support that has been seen a number of times over the years from the government there. Obviously, there are a lot of questions regarding that. We're currently in the middle of the US election, and that will potentially have short-term impacts on markets, higher volatility, perhaps a little more deviation in sector performances and so on. But ultimately, the long-term story is driven by growth in economic activity, growth in profits, and from that perspective, there are some potential questions out there, but the US is still looking reasonably secure. returning to the Magnificent Seven, the chart on the left is showing you the performance of those 7 tech stocks that I've referred to. Is the bright pink line at the top, that have returned more than 40% since the start of the year. And then the dark blue line here is the broad US market, represented by the Bloomberg US Large Cap Index. And then the pale blue line is that same broad market, but excluding the performance of those 7 stocks. What I think this chart does is sort of illustrate the fact that the US market can continue to prosper, even if we're seeing potential for weaker performance for the Magnificent Seven, given how far and rapidly they've travelled, and you can see that in particular in the third quarter of the year. So clearly, Mag 7 outperformed very strongly in the first half, and the broad market, significantly outperformed the market X Mag 7. In the last quarter, however, we saw a softening of performance for the Magnificent Seven, and although you did see a move down in the broader market, it was by no means as extreme, and actually from that point on in the last 2.5, 3 months, we've actually seen the broader market start to outperform and make new highs and repeated new highs, while the Magnificent Seven have yet to reach their previous peak in July. So that broadening out of the market, I think, is an important factor. It means that you're not putting all of your bets on the Magnificent Seven. And I guess the other thing I'd say is that if you're thinking about portfolio construction and areas of the market that you need to have an awareness of or a view on, I think the chart on the left really makes the point that the US is really, too big to ignore at 70% weight in the standard developed market investment index, which is the MSCI World. So on a market cap weighted basis, it has a huge influence on the performance of most investors' portfolios. Even if you did it on an equally weighted basis based on number of stocks, it's still 40% of the portfolio. So it still has a huge part to play, whatever the outlook.
So as well, as you mentioned, for the world indices, there is possibility for the clients to select like market cap weighted, and as well the equal weighted. This is the true as well for the popular indices in USA, like for example S&P 500, where the clients has the possibility to select as well the market cap weighted, but as well the equal weighted, and the same for Nasdaq 100. So let's talk now a little bit about these 2 indices, like S&P 500 and Nasdaq 100, because I think that these 2 indices are very popular among the public and as well in the professional space. And as we already showed in the couple of slides, that these has been the most demanded and as well the best performing indices so far. But the question would be, both of them are US indices, both are covering, these US markets, and are as well consisting of the biggest companies in the US market. So maybe could you share some differences between these 2 indices and what are the main characteristics of them? And as Invesco is the leading ETF provider of tracking the Nasdaq 100 index, so why is specific this index so popular?
Yeah, so I guess the reality is that, as you say, Eva, Nasdaq 100, S&P 500, they're both giving you exposure to the biggest stocks in the US market. In terms of the differences, the key difference is really one of focus, if you like. S&P 500 gives you a reasonably broad exposure to the biggest stocks in the market. Nasdaq 100 is giving you exposure to the 100 largest non-financial stocks that are listed specifically on the Nasdaq Stock Exchange. There are 2 listing venues in the US primarily, so the Nasdaq and the New York Stock Exchange. The Nasdaq tends to have companies listing on it that are perhaps a bit more innovative, a bit more forward-looking, a bit more growth-biased in their behaviour. And actually, the Nasdaq Stock Exchange itself is that as well. It was the first electronic exchange and an alternative listing venue compared to the sort of slightly more staid slightly more historic New York Stock Exchange. So if we look at what the NASDAQ 100 exposure is giving you, it's very much giving you access to innovation and innovative companies. Excuse me. So if we look at probably the best measure of innovation in company activity, which is R&D expenditure. Obviously, the more you spend on R&D, the more likely you are to get, new intellectual property, new ideas, new products that give you a market-leading position. And if we look at spending on R&D in the NASDAQ 100, excuse me, the average company in the NASDAQ 100 spent twice as much on R&D on average last year compared to the average company in the S&P 500. And actually, if we look at the breakdown in terms of dollar, the weighted average annual expenditure on R&D, NASDAQ, the NASDAQ stock exchange, the NASDAQ 100 or the NDX, as we're referencing it here, as you can see, was, like I say, almost double the level of R&D. Actually, if you took the stocks that are in the NASDAQ 100 out of the S&P 500, you can see it's that those are also the most innovative stocks in the S&P 500 index itself. Two ways of measuring this: one is dollar per share. Sorry, dollars on average per company. The other is to look at it as R&D as a percentage of sales, and again, you get a very similar picture. Much more meaningful expenditure on R&D as well. So I guess then the next question is, does that R&D spend actually translate into stronger growth, stronger activity? And the simple answer is that yes, it does. If we look at fundamental measures of company success, which are revenues as the starting point, higher sales, faster sales is likely to lead to faster earnings. Earnings is obviously the outcome of that revenue less costs, and then finally for an investor, the other area you might care about is dividends. So going from left to right within each column, if we look at the NASDAQ 100 index on the left here, revenue growth has averaged just under 10% per annum over the past 10 years. Earnings growth has been almost 13% per annum, and dividend growth has been more than 11% per annum. If you compare that to the S&P 500, you can see it's almost double the level of revenue growth, almost 50% higher in terms of the rate of earnings growth, and similarly meaningfully improved in terms of dividend growth. And even if we compare the NASDAQ 100 index with, a sort of more typical growth index, so something like the Russell 1000 growth index, this is an index that is constructed to pick stocks based on their sort of growth-like attributes. You can see that the NASDAQ 100 is also, significantly ahead in terms of fundamental growth than that broad growth index. And that's as a result of that spend on R&D, strong brand equity, the valuable patents that come out of that, and the growth that comes from these large innovation-focused companies. Another way you can look at the exposure to innovation in the NASDAQ 100 is to look at the exposure of the companies within the index to innovative themes. So thematic investing has been a staple of investors for a number of years now. And with a thematic idea, you're looking for a technology or a product or an exposure, or a theme that is expected to have a long-term structural growth driver behind it, and that may be technology. Say, for example, AI and big data that has been a big part of the market recently. It may be clean energy or the green economy. It may be aging populations and the need for better healthcare and innovation in healthcare. So there's a wide variety of themes that we're looking at here, where the NASDAQ index itself has a meaningful exposure. So there are two ways of looking at this. On the left-hand side, we're looking at the number of companies within the NASDAQ 100 that have exposure to these themes. On the right-hand side, we're looking at the weight in the NASDAQ 100 index that those companies make up, and their exposure, therefore, the overall exposure of the index to those themes. So you can see things like AI and big data, perhaps unsurprisingly, 30 companies making up 60% weight in the index is the biggest exposure to themes, but also things like the metaverse, robotics, biotechnology, healthcare innovation. There's a wide range of sort of thematic ideas that you're getting exposure to if you're investing in the NASDAQ 100. The other way of looking at sort of exposure to innovation is also to look at the outcome of that R&D spend that we've been talking about. And the slide that I've put up here is showing you the exposure in terms of patent contributions of the NASDAQ 100 companies to disruptive technologies. So what we're looking at here is the percentage of all patents in the study. So this is US patents. The percentage of all patents that are have been filed in a 12-month period. What percentage of those have been filed by NASDAQ 100 companies? You can see that the biggest number here is 40%, which is in the area of natural language processing. This is computers learning and understanding language and building on that technology. So that 40% of all patents is accounted for by 13 companies within the NASDAQ 100 that have at least one patent in this space. And actually, if you look at Alphabet, Amazon, and Apple, so the three of the biggest companies in the NASDAQ 100, they cover about 32% of all NLP patent activity as well. That's a sort of detailed dive on one area. You can see that there's a wide range of other activities going across. AI is obviously a big subject area at the moment, so NLP is one area of patent activity there. Also things like speech recognition and chatbot technology, cybersecurity, cloud computing, deep learning, image recognition and big data are other obvious extensions of that AI patent space, and make up you can see that the NASDAQ 100 companies make up a significant proportion of patent filings in those areas. But it's not just AI, it's also things like wearable tech, quantum computing, information and optics, the Internet of Things, so the increased integration of technology into our everyday lives, spacecraft and satellite, robotics and healthcare, a whole range of patents that gives the NASDAQ 100 an advantage in terms of innovation. So the final thing I'd say on the NASDAQ 100 is, it's worth bearing in mind that the NASDAQ 100 is a very simple index. It is quite literally the 100 largest stocks, excluding financials, that trade on the NASDAQ stock exchange. And it was designed as a sort of a measure of the performance of stocks on that exchange, if you like, a bellwether of performance on the NASDAQ stock exchange. Simple methodology, rebalancing quarterly, reconstituted annually, with some simple caps to ensure investability. The reason you're getting this innovative exposure through this index is that the NASDAQ stock exchange itself attracts innovative companies, and they are the driver of that innovative growth that we've seen on the previous slides. I guess the final thing to say is on the NASDAQ 100 is if you think about the outcomes that you would hope for from these kind of growth companies with strong innovation, that's exactly what you've seen from the NASDAQ 100 index. So on the slide you can see the performance of the NASDAQ 100 in lighter blue, the performance of the S&P 500, so the bellwether, as it were, for the broader US equity market, in dark blue. And over the last 17 years that this chart looks back on, so this is the longest period we can look at the net return index performance of these two indices. You can see that the Nasdaq 100 has significantly outperformed the broader US equity market, and this is over a period where the broader US equity market has outperformed the wider global equity markets as well. Invesco itself, obviously, we're one of the key partners of Nasdaq, the index provider, and a market leader in Nasdaq exposure. So Nasdaq 100 is just one example of that, and we've been working very closely with the Nasdaq team for many years, specifically for Nasdaq 100 exposure in Europe. EQQQ, the Invesco Nasdaq 100 UCITS product, was launched in 2002, should I say, and has been trading for more than 20 years on the stock exchanges in Europe, giving efficient, effective exposure to the Nasdaq 100 at a relatively attractive fee.
So this is for the investors, one of the best options if they are looking just to have in one product or in one ETF coverage of the biggest and most innovative companies listed on the Nasdaq stock exchange. So one of solutions for like a lot of companies which are innovative. Now I would like to move on to S&P 500 index, because this index is one of the most popular index in the world for US equities. And Invesco has one of the best performing and largest swap-based S&P 500 ETF. Please, could you explain why we have outperformed other ETFs tracking the same index, and give us some more details about this ETF?
Yeah, of course, happy to do that. So, first of all, to talk about the S&P 500 exposure, this is an area where you have effectively two options in terms of as a fund manager in getting manufacturing an ETF and offering exposure to the market, and it's a good place to illustrate the advantage of both of those options. If you think about what an ETF is doing, it's looking to track the performance in most cases of an index. In this case, we talk about S&P 500. The obvious and simple way of doing that is to manage a physical portfolio of equities, and typically on S&P 500, most funds will be what's referred to as full replication models. So they'll do exactly what you would expect. They'll buy all of the stocks in the S&P 500 index in the correct weights in order to match as closely as possible the performance of that benchmark. The other way of doing this is to use a swap-based approach. And a swap-based ETF is actually quite similar in terms of the basic underlying holdings to a standard physical fund. The ETF is buying a basket of equities. The difference from a standard physical fund is that the equities the fund is buying won't necessarily be exactly the same as the equities in the index it's tracking. And instead, what it will do is use a swap contract. So this is an agreement with an investment bank to swap the performance of the basket that you're holding in the ETF for the performance of the index that you're tracking through that contract. And in effect, what that's doing is truing up the performance of the basket you own for the performance of the index you're tracking. One of the reasons we do that is because you get significantly better performance on certain markets, and S&P 500 is a great example of this, through that swap counterparty or through that swap exposure. You can see it illustrated on the chart here. So the chart is looking at the performance of the three different groups of funds. The first is the performance of the average physical S&P 500 ETF in the UCITS space. So looking at the largest funds in here and taking an average exposure. And on average, physical funds actually outperformed the standard net return index by around about 0.15% over the last 12 months. The second group here is the average performance of the largest swap-based ETFs, excluding Invesco, which outperformed by just over 0.25%. And then the third line here is the performance over the last 12 months, cumulative return over the last 12 months relative to the net return index of the S&P 500 ETF from Invesco. The reason that all of these products are outperforming rather than underperforming their benchmark is because all of these products have a withholding tax advantage. So if you look at the performance that the ETF is receiving, the assumption that is built into the standard net return index is that any time a holding of the ETF is distributing a dividend, that 30% of that dividend will be withheld and kept to pay the tax man in the US. In reality, all of the physical funds that we're looking at here are domiciled in Ireland, so they're based in Ireland, and Ireland has a tax treaty with the US, which means that rather than being withheld at 30%, they're being withheld at 15% withholding tax rate. So even after fees, and the typical fees for these physical funds is somewhere between 0.03 and 0.07%. Even after those fees, you're still able to outperform because of that withholding tax benefit. It's exactly the same story if we look at the synthetic funds or the swap-based funds. The difference is, though, that the swap counterparties that these funds are working with are able to receive gross performance, so zero withholding tax, rather than 15% or 30% withholding. So you can see that they're outperforming by a bigger margin because of the influence of that withholding tax advantage. And in the case of our S&P 500 product, we also have a very low fee at 0.05% per annum as well. In terms of how the swap-based ETF works, I'm just going to jump to another slide to sort of discuss that in a bit more detail, because I think it's important for everyone to be aware of exactly what's going on with the ETF. As I said earlier, a swap-based ETF is buying a basket of equities. That basket of equities is wholly owned by the ETF, by the fund, for the benefit of its investors. And actually, the role of the swap contract, swapping that basket index return for the index return, is just covering the difference in performance between the basket you own and the index you're tracking. If I give you a simple example, if on you had $100 million portfolio, and on a given day the index you were tracking, the S&P 500, for example, was up 1%, and the basket you owned was flat on the day, we'd end the day with a $101 million fund, which was made up of $100 million of equities in a basket and a $1 million IOU, or $1 million debt obligation from the swap counterparty, or swap counterparties in our case, to the fund. The way that we deal with that requirement, the risk of being exposed to the counterparty, is that we then reset the swap whenever that $1 million IOU in our case is big enough, and the next day you would the swap counterparty, the bank, would pass through $1 million to the fund. The fund would then take that, buy $1 million worth of equities, and we'd now have a $101 million fund with a $101 million basket. The other way that we look to reduce counterparty risk is to have multiple counterparties who we're writing contracts with. So in the case of S&P 500, we have 6 swap counterparties. that gives you a number of advantages, which is, first of all, if one counterparty has a problem or is not able to continue to write these contracts for the fund, it's easy to move the swap arrangement from one bank to another. The second advantage is it gives us a very good market in terms of pricing of swaps and what the banks are willing to pay through. And the third advantage is it also helps promote efficient trading in the shares of the ETF in the secondary market, the market where most investors will be interacting with the fund. I think it's also worth saying, a question we often get is, why is it that we're seeing the banks are willing to pay such strong performance through to the fund? In the case of S&P 500, we're getting gross performance from the banks less a 4 basis point swap fee. And the reason for that actually goes back to a piece of tax legislation that came into effect in the US in 2017, so 7 years ago now. That legislation is called the Hire Act, and Section 871M is the specific part of that legislation that applies in this case. And ironically, it was designed to force banks to pay a swap fee or a withholding tax equivalent on swaps that they're writing on indices. The reason they're able to pass through such strong performance on S&P 500 is because there's an explicit exemption for indices that have a deep and liquid futures market sitting behind it from being required to pay that withholding tax. So ironically, a piece of legislation that requires banks to pay tax made it very clear that on S&P 500 and a number of other benchmarks, they don't have to do it, which means that we're able to push them to pass through that stronger performance to the fund investors that are investing in our ETF.
Okay, then many thanks. That was very detailed and very technical explanation. And I think this is as well very helpful for the investor to really understand what is going on in the ETF, and as well to understand the nuances and how the product is structured. But to summarize it, maybe with one sentence, is that, as you know, that when you would like to invest as an investor to kind of to track some index, then you have to select one ETF, and investors have options to select the ETFs with kind of replication methods. And on the market currently there are a couple of replication methods available, like physical replication method, then sampling, and as well this swap-based replication method. So what Chris explained is just one of the possibilities how to kind of replicate the index. And for US equities, it makes sense to select the swap-based replication method for an ETF, because it brings the benefit of the outperformance of the other replication methods. So now you understand. Yeah.
I'll just add, Eva, just one more thing to add there. I spent a lot of time talking about structure and that replication method. The reality is that the funds that we have that are swap-based or physical, we offer both, are all UCITS funds. They're all abiding by the same regulation. They're all investable by all investor types. And really what we're talking about here is a structural advantage that means you're going to get better performance over the long run using a swap-based ETF. To give you some context around that, our S&P 500 ETF is the biggest swap-based fund in the world. It's currently just over $32 billion of assets under management. It's had around about $5.5 billion of new asset flows year to date. So continued strong growth in what is already a large fund. And that swap-based ETFs actually represent around about a third of flows within the S&P 500 UCITS space this year as well, and half of those flows have gone into our swap-based ETF. So this is a popular structure for investors that really understand the performance advantage they're getting, and 0.2% outperformance or 0.25% outperformance per year doesn't sound like a lot, but actually it soon adds up. And in the biggest part of your portfolio, any advantage you can get is an important thing to have.
Yes, exactly. Then let's move on to the last question today. So we spoke a lot about US equities, and when you can remember, you have showed us at the beginning as well the global equities, because global equities has been the second or like a third best performing after the US equities, and as well the flows been pretty spectacular in global equities. So maybe could you explain us why global equity ETFs could be the best product for the investors to start to invest in the equities? And maybe which of the indices which are available on the market in the global equity space could be the best options for investors, and why?
Yeah, so it's a great question. It's certainly something we've seen, in the European ETF market over recent years has been a marked increase in uptake of broad global equity benchmarks. And the reason for that is that you've seen more and more investors using electronic platforms to gain access to directly manage their own portfolios. And global equities make a lot of sense if you're starting out in investments. I think I showed the chart earlier with the breakdown of the global equity market. In fact, I can jump back to it for a second. If we look at the weights of different regions and different countries in the MSCI World benchmark, if you were trying to build a broad diversified portfolio using US exposure, European exposure, Japanese, UK, Canadian, etc., there's a lot of different parts of the market that you could buy. The alternative is you could invest in one ETF that gives you exposure to all of those market areas. So one example of that would be, for example, the FTSE All World Index. This is a broad, diversified exposure to both developed markets. I was talking about the MSCI World, and we had that on the screen a second ago, but it also includes emerging market countries as well. So 45 developed and emerging market countries make up the index, and it's covering 4,000 or 4,500 large and mid-cap companies across all those 45 markets. So if you're looking for exposure to equity markets, you're not looking to change your allocation towards one region or one subset of those markets. This gives a very good building block for starting your equity allocation. In terms of our ETF, I guess as the title of the chart says, we're aiming at giving low cost investing. We charge 0.15% per annum for the unhedged version of the ETF, 0.2% for euro hedged, or indeed GBP or sterling or Swiss franc hedged. So it's not just giving you broad, efficient exposure to the global market, it's also doing it in a very cost-effective way. To put it into context in terms of scale and growth, we launched this product around about 2 years ago. It currently has over $700 million of assets under management, and it's grown tenfold since the start of the year. So at the start of the year, we had $70 million. Today, we have $700+ million. So it's a strongly growing area, and it's getting a lot of use, in particular through that platform route.
Okay, thank you very much. So with one ETF, the investors who are not sure how to start investing into ETFs, then it's just to select one ETF, which is ETF which is covering the whole market, which is great start for all the beginner investors. And with that, I would like to thank you, Chris. Thank you for your interview. Thank you for your time. And I would like to as well thank you all for your attention. And please reach out to us if you have any questions or if you would like to know a little bit more about the market, about the ETS, about the indices, or any other interest you may have. Thank you very much and have a nice day.
Thank you all.